Gold!
Gold! More gold!
The cursed treasure of Cortez.
Gold!
Is this gold?
Gold. Solid gold.
On April 22nd, 2025, the price of gold hit an all-time high, reaching $3,500 and rewarding investors with a 30% return since the start of the year. At the same time, the stock market was in the midst of one of its most volatile months in recent history, falling and rising by double digits over the course of a few weeks. Gold is what's known as a safe haven asset, so in times of economic trouble, investors rush to buy gold, driving its price higher. Why is gold a safe haven asset? Thanks for asking. There are a few economic and even societal reasons for why this is. But there's also a third reason that doesn't get as much attention, and this third reason actually makes gold one of the most dangerous investments out there. But before we talk about that, let's start with the economic reasons for why gold is a safe haven asset. Number 1. Inflation. There is a long-standing belief that gold is an inflation hedge, meaning that if inflation rises, gold will too. Take a look at this chart comparing the real price of gold against US inflation. We can see the strongest relationship in the 1970s and early 1980s, when inflation was at its highest in decades. And theoretically, this long-standing belief makes sense. Gold has a relatively stable supply, as pretty much all the gold in the planet has been mined. Annual gold mining only adds about 2% of extra supply, and famously, gold is pretty hard to destroy. This stability in supply means that gold works really well as a long-term store of value, which it has been for the past 5,000 years. On the other hand, other traditional safe havens like cash or treasury bonds are negatively affected by inflation. Inflation reduces the purchasing power of fiat currency, like the US dollar, and reduces the real yields of treasury bonds. During an economic crisis, governments tend to print boatloads of money and take on more debt to try to stimulate the economy. Unfortunately, a side effect of the stimulus is that these policies are highly inflationary. Arguably, some of the high inflation the world experienced post-COVID was due to the fiscal stimulus governments provided. 2. Uncertainty. Unlike stocks, gold loves uncertainty. Just take a look at this chart comparing the real price of gold against an index of global uncertainty. When global economic uncertainty spikes, the real price of gold usually spikes as well. This is because movements in the market for gold are usually independent from movements in other markets like equities. We can see this from the low correlation gold has with other assets. So the sequence of events is this. If there's an increase in uncertainty, investors take their money out of risky investments like stocks, causing stock prices to fall. Investors then put their money in low correlation assets like gold, which causes the price of gold to increase. We can see this in the data. In 9 of the biggest stock market crashes since the late 80s, gold outperformed the S&P 500 and even offered a positive return in 7 of those periods. 3. Central bank purchasing. This is a fairly recent phenomenon. Since 2022, central banks have been massively increasing their holdings of gold. And, not coincidentally, since 2022, you may remember some economic crises, such as Russia's invasion of Ukraine, high global inflation, a potential global trade war, and China being China. Most of the central banks that have been purchasing gold the past few years have been from developing countries that either share concerns over the stability of the US economy or are looking for an alternative to replace the US as the world's leading economy. For example, after Russia's invasion of Ukraine, Russia's dollar assets were sanctioned, leading to many countries considering holding gold to diversify away from US assets. Rising US debt levels, a rising fiscal deficit, and a generally unfriendly US government have also concerned many countries over the US's ability to repay their debt, and the BRICS nations have proposed a de-dollarization of the world economy. By increasing their gold holdings, they could potentially create a gold-backed currency to one day replace the US dollar. Now moving on to societal reasons. For thousands of years, gold has been used in human civilization as a status symbol, as jewelry, and as a medium of exchange. Gold has value because we, as a society, value its shininess, longevity, and scarcity. In the most extreme of extreme cases, an economic collapse could mean that the fiat currency the world uses is useless, and society will go back to using gold as the predominant medium of exchange. Of course, this will most likely never happen, but when economies do face crises, there are definitely people who stock up on gold bullions, just in case anything happens. More psychologically, investors may be using the tangibility study of gold to inform its role as a safe haven. Stocks and bonds are intangible and only exist in computers. When things go bad, investors may want to look for security in something that's literally solid: gold. 3. Behavioural. Lastly, and probably most dangerously, the price of gold rises when economies crash simply because we think the price of gold rises when economies crash. Yes, sure, there are valid economic and societal reasons that I just went over about why the price of gold rises during economic crises. But another reason is simply because we have all agreed that it does. Like, if investors expect the price of gold to skyrocket after a certain event, they will want to buy it as soon as possible, which automatically triggers the increase in its price. This behavioral reason is probably the strongest reason for why the price of gold rises during economic crises, as there is a lot of research papers that have shown that the link between gold prices and inflation and uncertainty might be weaker than we think. One paper found that gold's track record of fighting inflation is a bit hit or miss. Another paper found that gold as an inflation hedge only works if the investment horizon is measured in centuries. And another paper found that gold as a safe haven for uncertainty is dependent on the intensity of the uncertainty and if gold is in a bear market. So if the behavioral reason is the primary driver of the price of gold, then this self-fulfilling loop brings a unique danger with investing in gold. The awareness of gold as a safe haven may lead to an unnatural increase in its demand after a crisis. Say, after a US president announces on-again, off-again tariffs. This would mean that the price of gold could artificially be higher than it should be, say an all-time high of $3,500. And a risk like this would mean that gold is no longer a safe haven, and investing in gold has enough complications as it is. Gold is a non-productive asset, meaning that it doesn't generate dividends or yields like stocks and bonds. In fact, actually owning gold bullions would cost the investor money through insurance and security fees. The only way gold investors make money is if the price of gold increases in the future, and this creates an investment incentive that doesn't lend itself well to the artificially inflated price danger that I just raised. And the data supports it. According to this paper, the real price of gold displays high degrees of mean reversion, meaning that it tends to return to its historical average after reaching highs and lows. We can see this when we graph the real price of gold against the real returns of the next 10 years. When the real price of gold is high, the next 10 years tend to have a negative real return. And the opposite is true when the real price of gold is low. So, if the real price of gold is close to an all-time high level, the returns of the next 10 years don't look great for gold investors. But who knows, past returns don't guarantee future results. Maybe this time is different. The recent rise in central banks holding gold, or even the rise in gold ETFs giving access to everyday investors, or even some other factor we don't know about, could all change the trajectory of gold's future price. I don't know what the future of gold is, but if there was a safe haven asset bubble and it were to ever pop, this would ironically create an economic crash that safe haven assets themselves could not fix.